Hello, and welcome to the Market View for August. I'm Rory Dowie, Global Equity Portfolio Manager here at Marlborough. August was another busy month for markets. We had second quarter company earnings, the Federal Reserve's two-way tug-of-war became a three-way one, and central bankers from around the world met in Jackson Hole, Wyoming, for their annual, invitation-only economic symposium. Let's unpack what mattered and what it all means for markets. Firstly, the two-way tug-of-war became a three-way one. The Federal Reserve, or the US Central Bank's primary challenge, is balancing its two key goals: maximising employment on one side and maintaining stable prices, which essentially means keeping inflation low, on the other. This is often referred to as their dual mandate. To manage this, the Fed uses monetary policy. When the economy is strong and inflation is high, they can raise interest rates. This would increase borrowing costs, so bringing down consumption and investment. When the economy is weak, they can lower rates, and that would stimulate economic growth. But right now, the Fed is in a tug-of-war between its two mandates. On the employment side, one end of the tug-of-war rope, we saw some weaker than expected employment data in August. The US economy added just 73,000 jobs, which was below expectations of over 100,000. The unemployment rate also rose to 4.2%, and to make things more complicated, the jobs growth numbers from the previous 2 months were revised down by a combined 258,000 jobs. So clearly signs of weakening employment. On the inflation side, the opposite end of the tug-of-war rope, we had some data that was indicated inflation was on the rise, and that was in the form of the Producer Price Index, or PPI. PPI measures what businesses are paying their suppliers, essentially the cost of production. And that data showed the cost of production jumped 0.9% in July, a significant acceleration from the flat reading that we had in June, and actually that was the largest monthly increase in 3 years. So signs potentially of higher inflation to come. And as if the Fed's job wasn't hard enough, President Trump has been trying to get involved in the tug-of-war, calling for rate cuts. Over the course of this year, he has kept pressure on Federal Reserve Chairman Jerome Powell to lower rates. And in August, it was Federal Reserve Governor Lisa Cook who was in the firing line for opposing rate cuts. You can think of Trump as getting on the side of maximising employment in this tug-of-war, i.e. Trump wants to boost economic growth by having lower rates. However, it is vital that politics stay out of this tug-of-war and remain independent from central banks. Another key event over the month was towards the end of August, where central bankers met in Jackson Hole, Wyoming. Given the two-way, now three-way tug-of-war, the spotlight was very much on them. One key theme that emerged was a strong reiteration of central bank independence, reinforcing that central banks must remain free from government interference. The symposium finished with a much anticipated speech from Federal Reserve Chair Jerome Powell. In that speech, while Powell didn't explicitly promise a rate cut in September, his comments were widely interpreted as opening the door to one. He stated that, quote-unquote, the shifting balance of risks may warrant adjusting our policy stance, which markets took as a strong hint of a September rate cut. However, he did reiterate that the Fed will remain data dependent rather than acting on any predetermined schedule. Finally, second quarter earnings season continued to tell a story of US tech dominance and the market leadership of the Magnificent Seven. These 7 largest US-based companies, all geared to the tech sector. The Mag 7 grew their earnings by 26% year on year. And actually, when you exclude those 7 companies, the rest of the US market only grew about 5%. That's a 21 percentage point difference between those 7 names and the rest of the US market. However, I would still highlight the US was still positive earnings year on year. Europe, on the other hand, had weaker performance. If you exclude banks from the European market, earnings actually declined 5% year on year, so quite a divergent picture in the US market versus what we've seen in Europe. Amidst this backdrop, markets were a bit more turbulent over the month. However, most major markets finished up between 1% and 2%, with the S&P 500 even managing to hit an all-time high. Given August has historically been the most volatile month for markets, and the current tug-of-war between inflation and employment, we remind investors to be patient. As Warren Buffett put it, quote unquote, the stock market is a device for transferring money from the impatient to the patient. In an uncertain macro world, be that from geopolitics, central banks, or volatile earnings, be patient and stay the course. Thanks for watching, and see you next month for another Market View.